My name is Dirk. I've been an investor and trader for 25 years, and I understand that your time is valuable. So I've condensed everything you need to know to start your journey into this one powerful video. No fluff, no filler, just practical insights, actionable techniques, and expert guidance to help you navigate the markets like a seasoned trader. This course consists of 5 chapters that will cover choosing the right hardware, software, and brokers, pre-trading routine, market overview plus upcoming news and events, market structure and break of market structure, how to find good trade entries and where to place your stop loss and take profit. Last but not least, risk management. Let math work for you, not against you. If you are already familiar with the topics of a chapter, you can also switch directly to the chapters that interest you with the help of a chapter timeline below this video. However, be aware that the concepts of this video build up upon each other, so it is of course best to watch the video until the end. This course is also intended for you to really work with it. So take your time and try to comprehend and internalize the concepts taught by pausing the video and trying everything for yourself on your own charting software. I use the techniques taught in this video also during my live trading sessions here on YouTube. So if you also want to see them live in action, consider leaving me a like and subscribing to my channel. Also make sure to check out my Telegram channel where I write about the markets and update my trades when not streaming live. Talking about hardware, software and brokers can seem to be a bit mundane, but from my experience, all of these 3 are essential items when it comes to your trading success. Here's what I can recommend, which is, by the way, also the setup I use for my live trading sessions. Hardware. Yes, there is this cliché that a trader needs a setup with 6 to 10 screens because, it looks so professional. The truth is, you do not need that. I work with 2 screens, well, 3 if you count the one monitor behind me as well. I'm using a desktop PC with a medium-fast NVIDIA graphics card and plenty of space on my hard drive, plus 32 gigabytes of RAM. Software. For almost all my charting needs, I use TradingView. In my opinion, it's the most flexible and powerful charting software there currently is on the market. It allows me also to code my own indicators and strategy in their coding language PineScript, which often makes my life much easier. Broker. For my day trading and swing trading activities in cryptocurrencies, I almost exclusively use Fairdesk. Apart from really good trading fees of 0.02% for taker and 0.04% for maker orders, extremely fast and accurate trade execution, they also take their regulation seriously by having the US MSB license and the Canada MSB license. On top of that, the company is physically located in Singapore and not in a somewhat sketchy place, at least when it comes to finance, like the Seychelles or Mauritius. And yes, due to their licenses, they also accept clients from the USA. If you use the link in the pinned comment of this video to open an account with them, they will give you the VIP 1 status right away from the start. That gives you an additional 5% discount on the already low trading fees, plus a deposit bonus of up to 100,000 US dollars. As for Forex brokers, make sure that they are regulated by a trustworthy regulatory body such as the FCA in the UK or CySec for the EU, plus that they offer accounts with so-called STP, straight through processing, and do not B-book their clients. STP means that client orders are executed really on the true markets and not internally by the broker itself. A B-book means that the broker is taking the opposite side of its client's trade, meaning that the broker will earn money when its clients lose money. A conflict of interest, to say the least, in my opinion. Do you know what the difference between, let's say, a professional athlete and a strong amateur athlete is? Very often it is actually not that the pro has the better technique, but that the pro is very consistent in what they are doing. Look at pro golf players, for example, and notice how they always have the same pre-shot routine. They do this because they know that this routine will increase the chances of giving them the expected result. The same is true for trading. If you have a daily routine on how you approach the markets and risk management, you will, over time, also see that your trading results become more and more consistent and, yes, predictable. I always start my trading days, or let's call it pre-trading routine, with getting an overview of what happened on the markets while I was sleeping, plus looking at certain key assets in terms of where they currently are trading from a point of support and resistance. For the news part, I usually read over the headlines of websites such as Bloomberg.com or the Financial Times. I do not read through every article, but only the ones that spark my interest or point out things on the markets that might have slipped my attention. Bloomberg also offers a great free daily newsletter called 5 Things You Need to Know to Start Your Day, which is a must-read for me amongst other great event-driven newsletters. After that, I want to get an overview of some of the key asset classes on where they are currently trading in regards to support and resistance. Until recently, I was drawing all these support and resistance levels by myself and would update them daily. However, a while ago I switched to a more automated process utilizing 3 free indicators that basically take that repetitive daily work a bit off my shoulders. Dynamic support and resistance zones by sharpen and greed zone and fear zone by Diamond Trading. You can of course find links to these 3 indicators in the description of this video. Let's look at the daily euro-dollar chart to see what information and possible trading ideas we can get from this chart. First of all, we can see with just one glimpse where currently the major areas of support and resistance are due to the extra drawings that are added on the right side of the chart. For euro-dollar, these are currently the 107 area as support and a quite massive resistance around the area of 109.50 to 111. In addition to this, we can see red and green lines that sometimes appear above or below the chart. These are from the greed and fear zone indicators, which start to appear whenever the markets become either too euphoric or too fearsome. In order to already take action from just looking at this type of chart, I want to see areas of support and resistance lining up with times when there's either too much fear or greed in the asset I'm looking at. For euro-dollar, you can see here, for example, that these signals alone work already very well, with 8 out of the last 9 times highlighting areas where euro-dollar eventually started trending into the opposite direction. So if you are somebody with a very limited time budget, this is already a trading strategy that you can use with maybe just spending 20 or 30 minutes every day looking at charts. You can of course use this overview on any asset and time frame out there. However, I like to primarily use it on the so-called key assets such as euro-dollar, dollar-yen, pound-sterling dollar, Aussie dollar, the S&P 500, gold and Bitcoin US dollar. What do I mean by key assets? Well, key assets are usually the assets whose movement also have big impacts on other assets. When, for example, euro-dollar goes down, this indicates a so-called risk-off move, where the US dollar gains strength versus the euro. You usually will then also see in other currency pairs with the US dollar, such as dollar versus Canadian dollar, Aussie dollar, Kiwi dollar, that the US dollar becomes stronger. So instead of having to analyze each US dollar pair every day separately, I stick to the pair that has the biggest impact overall. Same with, for example, the S&P 500. When it goes up, other indices around the world tend to do the same, which is also true for Bitcoin and its influence on the direction of which all other cryptocurrencies are developing. Last but not least, I want to have a look at what economic data will be released during the next couple of days. I like to filter only for economic data which release really will have an impact on the assets I am trading for that day or week. I like to avoid day trading and shorter time frame swing trades during the time this data is released due to the huge spikes and volatility it can cause, especially if the economic data deviates a lot from what was expected. Look, for example, at the spike of almost 100 pips in euro-dollar that we had right after the release of the so-called non-farm payrolls. Events like this can totally change the market structure and are often a gamble if you want to trade them. I actually made a video a while ago about how to approach news trading in a more structured way. So if you are interested in this aspect of trading, click on the link above. Alright, now that we have our overview ready and we have a rough idea of the general direction our key assets are trading, it is time to start looking for good entries into day trades and swing trades for the assets of our choice. If you are a beginner, I recommend that you stick also to the key assets. It is better to watch 1, 3 or 5 assets and get to know them better than trying to find entries for 100 different assets. One of the secrets to succeeding in trading is to be picky about your trades and not jump blindly into trades because you know you like the clickety-click action so much. Especially when you are trading short-term, it is vital to find the times when an asset is starting to become volatile and stay out of the markets in phases where not much is happening. These phases are, by the way, also the reason why no magic indicator in this world will always be correct, no matter what is happening currently. In order to find these times where prices really start to move, we need to do 2 things. Analyze what the current market structure is and find moments where the structure is either likely to continue or when there is a break in market structure. What do I mean by market structure? Well, in a nutshell, markets can have 3 different phases: an uptrend, a downtrend, or a sideways trend. You will find these on all time frames, from 1 minute to 1 week to 1 year. In order to understand what the current market structure is like, I like to look at a 4-hour and 1-hour chart. Let's take a look at the euro-dollar 4-hour chart. Would you say this is an uptrend, a downtrend, or a sideways trend? Well, first of all, it depends, of course, on the amount of data you look at. Since I want to concentrate on more shorter time frame trades, it does not make much sense to zoom out too far. So let's concentrate on, for example, the prices from the beginning of 2024. We can see that since January 2024, euro-dollar has pretty much entered a downtrend characterized by a series of lower highs and lower lows. This is the longer-term market structure we are dealing with at the moment. This market structure would only change if we see a new higher high than the last one around 108.80 to 109. Prices above that would be a so-called break in market structure, where euro-dollar would likely start to form either a new uptrend or sideways trend. If we zoom in further, we can also see that within that downtrend, a shorter-term uptrend has recently established itself with higher highs and higher lows. However, if we look at this uptrend structure at the 1-hour chart, we can see that it is a bit choppy and not really a textbook uptrend. Remember the overview chart I showed you in the last chapter for Euro-US dollar, where it clearly showed that there is quite a massive area of resistance spanning from 109.50 to 111? Well, looks like this might be at least part of the reason why the uptrend on the 1-hour chart is a bit choppy. Now you might ask yourself how this can help you to identify trading opportunities and where to enter and exit trades. Be patient, we will get to that in a short while. However, please always remember that for a pro trader, it is essential to always understand the current market structure of the asset he is trading. It is essential to identify when volatility and thus greater chances for us traders is going to pick up. In order to identify these areas where the best trading chances lurk, we need to add one last ingredient to the mix: zones of confluence, where natural points of support and resistance align and cause these continuations or breaks of market structure with high volatility probabilities. I like to add the following 3 indicators on TradingView to help me with this. Spaceman BTC key levels. Although the name suggests it, you can use this indicator also very well for other assets than Bitcoin. The indicator shows us significant levels where euro-dollar was trading in the last week, quarter, month and year. These levels are often viewed by institutional investors from banks and hedge funds, and often you can see a lot of volatility and price action around them. We can also add so-called Fibonacci levels to gain further insights and see if we can find levels where our Spaceman key levels, Fibonacci levels and last but not least moving averages align. In the case of euro-dollar, things seem to not be so interesting at the moment. There are no clear confluence levels that could show us where the action is likely to pick up. So let's move to an asset that has more action currently: Bitcoin. Here, things look a bit clearer in my opinion. First of all, we are sadly still in an overall downtrend, at least on the hourly chart. But notice the following. After applying our Fibonacci levels, there's a great area of confluence where the previous week high and the 50% retracement align almost perfectly. Bitcoin had difficulties overcoming this area before and finally did shortly after 10 AM on the day before I recorded this video. If we go to the 1-minute chart, we can actually see that Bitcoin was indicating to do this already the whole morning from the start of the European session, when it traded above the 200, 50 and 21 minutes EMA. As I usually start to trade around 9 to 9:30 AM, I became more and more convinced that we could see volatility picking up soon to the upside, and I entered trades on the 2 pullbacks to the 21-minute EMA 2 times before the breakout. The stops for these trades I placed slightly underneath the 200-minute EMA and my take profit 2 times as far away as the stop loss to maintain a good risk-reward ratio. More on why that is important in the last chapter of this video. Let's summarize what we have learned so far about identifying the levels or price zones where potentially profitable trades are likely to occur. First, we want to identify the market structure the asset of our choice is currently trading in on a 1-hour or 4-hour chart. Second, we want to add the indicator Spaceman BTC key levels, Fibonacci retracements and 3 exponential moving averages with a length of 21, 50 and 200 to the chart. Third, we want to look for areas of so-called confluence where 2 or more of the key levels, retracements and moving averages overlap. Once the price of our asset reaches these levels, we want to go down to the 1-minute or 5-minute time frame to confirm the price action. For potential long trades that indicate either a breakout over a resistance or continuation of the trend, we want to see the price of our asset trading above the 3 exponential moving averages plus the 50 and 21 EMA must trade above the 200 EMA. We can then enter trades, in our example long trades, on the pullbacks of the price to the 21 and or 50 EMA with a stop loss slightly underneath the 200 EMA. The take profit should be 2 times the distance of the stop loss. If you are a bit confused now and still unsure how to apply these concepts to your own trading, Don't worry, this is completely normal. It takes a bit of practice to internalize these concepts and to get a feeling for where currently are good areas of confluence and where not. It is actually the same as learning a new language or starting to play tennis. In the beginning, everything feels strange and difficult, but over time, your brain and muscles start to automate things for you. Nobody yet has become a pro at anything without diligent practice. So take your time and practice and only risk small amounts of money in the beginning until you get the hang of it. Talking about risk brings me to the last chapter of this video. Almost every person that starts trading and that I talk to during my career always thinks that the most important thing to have for trading is a good trading strategy. And while that of course is important, it is even more important to stick to a good risk management plan. While a high success rate of, let's say, 85% winning trades sounds great on paper, it will not help you if one losing trade destroys the amount of money you earn from 5, 7 or 10 winning trades. In order to become successful, you need to achieve that the average amount of money you earn from a winning trade is much higher than the average amount of money from a losing trade. Let's look at why that is the case. Remember that in the Bitcoin trades I talked about in the previous chapter, I said that I placed the take profit for my trades at 2 times the distance of a stop loss? I did this, of course, for a reason, because I want over time that math and statistics work for me and not against me. By risking, let's say, $250 to earn $500, I only need to have a success rate of 33.3% to not lose money. So even if my success rate is well below 50%, I will still not lose money or even earn money in the long run. In addition to that, it is wise to not risk more than 1 to 3% of your capital per trade, because even with a success rate of well over 50%, you will eventually have a losing streak of 3, 5 or even 10 trades in a row, which will crash your account if you always risk 10, 20 or 50% of your balance on each trade. If you stick to this type of risk management, chances are actually quite good that you will be able to earn money without already having a super awesome trading strategy. I would go as far as claiming that good risk management is one of the things that usually separates the pro traders from the novice traders. And by the way, professional day traders usually have a success rate of 50 to 52.5%. So it's wise to maybe not think that you will be able to long-term win 85% of all your trades, right? This brings me to the end of this short video course, which will allow you, if you start working with the concepts taught, to really get your trading to the next level and finally start becoming successful with trading. If you like content like this, please consider leaving me a like and subscribing to my channel. That way you will never miss out on a new video or a trading live stream. Until we see each other again, happy investing.